Fantastic, and just want to apologize to everyone. So yes, so let's start this, and I really am sorry. I'm not very good when it comes to technology, but let's kick this off. So what are we going to be doing in today's webinar? We're going to be looking at a case study of one of our young trainee traders, and we actually had a really good team meeting tonight. Every Wednesday night we have a team meeting on the floor discussing various things. Most of the time it's skills workshops on various edges and where traders are doing well, where traders aren't doing that well, and whether it's certain type of profile plays, order flow patterns, or various geopolitical events, central bank trading. We approach all of these, every Wednesday just to kind of summarize the past week, so people always benchmarking best practices. And this week we're actually, for the last few weeks, we've been using. It's been really fascinating and great seeing these new patterns that the traders were perhaps conscious about, but they didn't really see it visually. And it's amazing when you see something visually within your performance, when you look at your performance analytics of how you can really start adjusting and refining your trading. So let's go through a couple of the slides. So just firstly, there's also always definitely a skill in using your stats. It's one of my favorite sayings, and I remember when I did statistics at university a long time ago is, this quote that came up: most people use statistics like a drunk man uses a lamppost, more for support than illumination. Now, there is a skill set in how you even use your stats, and within trading even more so, because in trading, you firstly have to have an edge. You have to have developed a way to map the market and be able to deploy various arsenal of strategies on the market given the typical environment, the volatility landscape. And so important before you analyze any stats. If you have no edge and you can't, the stats aren't going to give you any information. So in the first instance, you start with your edge framework. And so as I mentioned, before analyzing any of your stats, you need a market edge. And from here, the power of your stats can reveal so many blind spots and really help refine your approach and optimize your P&L efficiency. And in our case study today, one of our younger traders, he's a trader that's, he's still trying to, he's been around with us for a year on a live account, really kind of struggled in the beginning, but he's now starting to slowly show a deep understanding for the market shape, but he still hasn't really optimized his money and his risk management. He's the type of trader that can make anything between 800 to 2,000 euros on an up day. Has his downside is about 1,000 euros on the downside. So just so you get an overall view of what we're looking at and what we try to implement in this type of pattern that we saw with him. So then and what a lot of our traders have said on the floor, sorry, before we go there, what a lot of our traders have spoke about on the floor is it's also helped them gamifying their trading. Sometimes when you look at the calendar, you're seeing a couple of green days, or you're looking at your performance per hour or your trade distribution. It also gamifies your experience around your edge. And this, and I think just it's pure human psychology. So we like to play, we like to see games, and this has really contributed and helped to how a lot of the traders have been using the platform. And as I mentioned, and then all about seeing visually your errors. So this performance pattern we're going to be looking at today. So this is one of our junior traders, and obviously this is the zero axis over here. If you can follow my pointer, and what he's been renowned for, and something I've been trying to speak to him for a long time, but until he visually started seeing his performance, he didn't really realize how bad this was. And a lot of times he will see a setup, see a play that, and he uses market and volume time structures in order to lean towards his next, high probability play. And he accesses those trades through using, the price ladder. So, it's all well seeing where the market could contextually go in the next hour or 2 hours, but in order to optimize your risk reward and your entries, it's all about what you're seeing, what price patterns you're looking for in the DOM to optimize your timing, given the volume interaction or the auctioning activity on the ladder. So what we have over here is him, at 9 o'clock and 10 o'clock, at 9 o'clock making $200, and then another $700 at 10 o'clock. So he's up almost about $900 dollars at this stage. Now, what he's been renowned for is he sees a pattern, he sees a play, and he's got a lot of patterns and plays in the morning. But then what happens? Either he hasn't hit what he felt he should have made on the market, and once the move has happened, then you necessarily get the sideways chop or whatever edge that he's trading, and then he continues trading, and he's known to be in the market all day, lose a lot of energy, and he just slowly leaks his entire most of his day away. And this is just one specific day. If we had to look back at this over an entire year, you would see this pattern happening so much. And the repercussions of this is not only are you going to be more tired as a trader, you're also going to give a lot of energy. You're not going to be able to really size up when your conviction comes in. Because later on in the afternoon, after over trading the session, so giving away a lot of emotional energy, giving away a lot of risk capital. He then, there was a play for him, right in the afternoon, but wasn't able to take advantage of it because he had started sizing down. He had lost quite a bit of his day, and he wasn't able to really have another move. So if we look, I think it was the very next day so we've only just started using this performance analytics. Here's another one. Morning, executes, trades his play, 9 o'clock and 10 o'clock, and then slowly starts giving back to the market, on a non-conviction play, because, afterwards you go saying, well, what were you looking at there? And he wasn't looking at anything specifically. He says, I was just trying to build upon my day. So not process orientated, not objective. And slowly he's giving, and then eventually he capitulates his entire day. And this is actually trading a product that he's been shown since the beginning of the year to be done. He's really got a core, strong understanding of the bond futures markets in Europe, and his skill set at this moment isn't geared towards the equity futures. And that was actually the S&P 500. They lost that this platform also does provide. So that's what we're noticing. Trading hardly puts on any trades to get the P&L performance. Generally, when and this is across the entire floor, when people are doing a lot of trades, it's generally they're doing a lot of trades to have no P&L advancement and actually be losing money. So these are patterns. So now we're observing this pattern, and therefore, what are you going to be doing when you start observing these? Patterns. So just before this, this is another tool. You'd see his current trades. His winning trades mainly in the bond. And if you see this pattern over a period of time, obviously as your sample set grows bigger, you'll be able to see more of these hidden or these blind spots that you can focus on. And you can see his winning trades are predominantly in the bund. But you can see his losing trades are predominantly in the S&P 500. And his winning trades in the S&P 500 are very small, very small margin. You can see his bunds as a percentage of the entire pie is less so. So this is just other patterns. You're trying to draw conclusions from your main trading edge. Now, so I'm just going to give you a bit of background about this trader. He has a deep. He really does. He's in one of our mentoring groups on the floor where they focus exclusively on the market and volume profile landscape, and then using the price ladder to execute their trades. And he has a very deep understanding of the market and the time, the volume structure. He knows how to access his edge, and especially when he's fresh in the morning and he's developed his plan for the day ahead after taking the overnight news. And he has a really strong methodology that's dynamic in time and knows how to maneuver around, as the market dynamically shifts and the changing nature of the landscape. He knows how to manipulate the trading in the markets. But his biggest weakness, as that's evident in the statistics, is his inability to stop trading after the initial thrust. So a lot of times what we see, if something comes out of the market, there's a big macro moving news that comes out in the market, or there's a technical unraveling of a very congested zone, that they take that first wave and that first move. That after that first move, where your entry is as close towards where you'd like to risk money, you're getting into a leverage position, because this is the nature of trading the futures market. From a proprietary trading perspective, what separates the really good traders from the average trader is the ability to get into really high leverage positions and timing it really well. You can have guys with a 20% hit rate that make phenomenal amounts of money because they're leveraging up on their winning trades. So he has this inability to stop trading after the initial thrust. He gets tossed up in the churn, in the post move chop, and boredom starts creeping into, and he cannot locate his edge or pattern throughout the day. This then has a ripple effect for all his future trades. So, and this is a pattern that happens so often, especially amongst younger guys who are trying to build an account, where they stop understanding that it's all about the process of executing well on your edge and not trying to make money throughout the entire day. So these are the trading patterns, not only that you start noticing on their statistics ed, and once you start noticing these patterns, how are you going to go start shifting gears to fully harness your edge framework? Because that's what you're trying to do. You're observing your edge, you're observing the framework of your edge, and then you're using the supporting basis of your performance analytics to really utilize that to make sure that you're optimizing your P&L and your edge, and you're not giving money back anything beyond your edge. And this is what's so critical in order for you to become this really refined trading machine. So what is the implementation process once you've observed a clear performance pattern? So to ensure that it does not, so this is a really key point. So you can have an implementation process, of how much you want to give back, or, you stop after your first hour of your initial thrust of the pattern that you've seen. But you're also going to make sure that it doesn't affect the long-term dynamic future edge development. You could say, well, at this very moment in time, I never make money on my momentum plays in the S&P 500. I do in the Bund, but maybe that pattern will dovetail when the S&P environment changes 3-4 months down the line. But the fact that you've been clouded by your statistics means that you're not going to trade that pattern in the future, and then you're not going to be dynamically developing. There's both an art and a science of how to use your performance analytics, and also understanding the source of a clear performance pattern solution. So with regards to that, a lot of the reason why he was over trading was because at that stage, he was, he's down on the account, and he wants to make back the money as quick as possible. And that's in the first instance, trying to make back the money in the first. You're not being objective, because it's not about making money back. It's about making money on your edges. And if you don't have an edge in play, if you don't understand what's going in play, you shouldn't be participating, because you'll just be donating more money back to the back to the market. So one of those where he is having a bit of outside financial stress. So you're really trying to identify and isolate what is the reason for some of these clear performance patterns, and so what we were starting to work on with him, and we'll see what actually happened with his charts a little bit later on, and it's actually this week that we've implemented some of these as a proper give back and layer targets. So for example, if he goes up 500 euros on the day and he has another edge in play, he shouldn't be giving back more than the 500 euros that he's made on the day if there's a high edge. And a lot of times we've also noticed, generally when he trades an edge, he hardly goes down. His timing is so exceptional that he hardly gives back more than 100 euros on the trade. Making sure that he has the financial support outside of trading. This was a pressure that was being created, but which has now been sorted out. The process of being edge focused, just always having those dynamic questions of, am I trading a pattern, or am I just trading for the sake of trading? And then breaking up your day with the dynamic questioning and no trades in the market if there is no framework. So these were the things that we were really starting to focus on, and also being able to have gaps in his trading, on his trade distribution. So now I think this was on Monday. There was a play that they were looking at in the morning, the team. There was a setup, and the play never really happened. It was a high conviction play, but it never happened. He actually controlled the risk quite well. So then he took a break, and an edge, the reversal of this. So this market couldn't offer. This was Monday morning. If you want to go look at the charts, and when a few of the guys were trading it from the short side, it never worked out. Then was patient, waited for the market to develop again, and then there was a trade opportunity at 11 o'clock, which you went to the long side. then he effectively ended up, effectively scratched on the entire day. And then at 1 o'clock took another hour break. So now he's not only cultivated some energy, he hasn't overtraded, he hasn't continued to trade. And then he sees a trade, and in the next couple of hours, he sees a new pattern in the market that he understood. And this is what's happened. And you can see over here again the actual distribution of not trading always. He's in the market generally beforehand the entire day. And for the first time I've ever seen that, he's actually took a break and not trading. And then you start having this result. And if we start looking at this again, this is actually today's performance, where he had a lot more breaks. You can see his morning, so we looked at this first few charts. He's invariably got a really good pattern and a play in the first 2 hours of the morning. So instead of after 9 o'clock or 10 o'clock continue to trade, where he generally loses money from 11 to 12 o'clock, doesn't do any trading at 10, 11, 12, 1 o'clock, 2 o'clock. He has a nice little pattern, exposes himself again, trades it. And all of a sudden what happens here, the repercussions of this is rather immense, because now he can just focus on getting bigger and bigger on his edge, not losing energy by overtrading this sessions that he sees nothing, which means that when a new opportunity comes that fits within his edge framework, he can really execute it aggressively again. And this is dynamically into the next trading session as well, because at the end of the day, he's not as tired as the previous day. And if you look back again, you can see you're going to be a lot more tired as a trader. So if I can go back to maybe what slide was it? 3? No. You can just see how, if you're a trader, an intraday trader, and you're trading from 8 o'clock until 5 o'clock in a position all day, you can imagine how exhausted you're going to be. And when you're exhausted, the next training session, the next day, he had a red day simply because he had traded, he had sacrificed the day, but you could clearly see that he could see patterns in the market in the first couple of hours of the day. It's just during later on that he starts giving money back. And the prevailing thing is at the beginning, start of the day, he generally always is up, but then he gives it all away. So it was about putting a break after the morning session. And he told me, he said, Alex, I knew about this pattern, but until I visually could see this, he now has, starting to gamify this process. He now doesn't want to see these types of red patterns. So by actually looking at the analytics, looking how it can benefit him, seeing of how he can enhance his edge, which is this zone over here, and make sure he can build that up even higher and higher, whilst not participating when he's not seeing a pattern, is really to stand him in good stead in the future for really developing himself as a seasoned professional trader. So I was just using this as a case study for those of you who are using. We really on the training floor incredibly. I mean, the feedback has been tremendous with regards to people using this platform and just really helping. But again, you have to first cultivate your edge and then start using the stats to really refine almost the money management, risk management, and the time that you spend in the market, and also the product selection. So just a very brief, quick overview. I think when I first spoke to you, he said this was mainly going to be a Q&A session. So I hope that gave a little bit of insight on using one case example of how we like to approach it with not only our younger traders but our senior traders. Even the senior guys are looking of how to really optimize their game. And I know there's some really exciting new things that Peter's going to be implementing on here that we really can't wait to start using. So yes, so I hope that gave you a bit of insight on example of one of our younger traders and how we're trying to get him better and bigger in his approach to the market.
All right, Alex, what I'll do is I'll field the questions. Sorry, Alex. Right, so you can start typing your questions in. Obviously, there's some misconceptions about what people think of proprietary trading. You might think they're hammering it away all day. So if you've got any questions about any topic really on proprietary trading, just go ahead, put it in the chat or in the questions now. Right, so the first question, Alex, do all of your traders use order flow, or are some just trading price action patterns?
We all use order flow. The entire floor. It's kind of the first thing when they come onto the floor and trade. We actually don't even have charts in the beginning, on the training course. We try and get them to really understand the auctioning nature of the market, because it's the auctioning nature of the market that's going to help you get into leverage positions on certain high conviction technical setups. So you can give two traders the same technical chart. One doesn't use order flow, the other one does, but the one that does will be able to get a lot more increased positioning, because you're seeing the right type of order flow of how it's approaching that level, and the other one uses the same size clipper approach, and he doesn't make as much money. And the converse is true as well. When you're looking for a momentum breakout on a certain chart, you give it to two traders, one using the DOM, the other one not using. It breaks it by a little bit, but you're seeing on the price ladder, there's not the right auctioning activity happening, and you can actually start scaling out your position a lot quicker, whereas opposed to the person's potentially just trading off the technical charts, will only kind of start liquidating this position once it takes out one candle previous low. So for us, it's what we breastfed when we first come into the proprietary trading world is the price ladder. It's the very first thing that we look at.
Okay, Alex.
And build skills around.
Sorry about that, Alex. Right, so Jeremy's asking about FX. I presume you've got no FX traders in your various groups, right?
What we do, we don't.
You've got no. Do you have any forex traders in your group?
Oh, I mean, we have lots of guys who trade the FX futures, yeah. So I mean, during central bank events and that, the guys will trade the majors, Euro, USD, the cable on so sterling on any Bank of England or any technical setup. Yeah, we trade, but we trade the majors. We don't trade any. The only most exotic ones we do trade is this, the code is 6Z, the CME code, and that's the South African rand. The guys were trading it during the whole Zuma political instability over the last couple of years. So occasionally trade that. The Mexican peso is another exotic one, but it's mainly the majors and exclusively futures. As long as we can trade it on the DOM and there's enough liquidity and there's opportunity and volatility, the guys will trade it.
Yeah. So thanks for Alex. Bruce is asking, could you please explain leveraging up a position? And I'd like to add to that, Alex. You can explain leveraging up, but you can also explain how they decide when to.
Yeah, so I mean, this can take, this is a subject matter that we can talk on for a very long time. So I can give you a very brief summary and for example, actually today that we had those comments from Trump around midday that he's not going to be as aggressive on China, with all these tariffs and trade wars, and so this at that very moment, you're seeing large orders come into the order book across the market. So it has a systemic influence, and what I mean by systemic, it's influencing all the markets across all the asset classes, the FX futures, the interest rate bond futures, the equity futures, and so this is more a macro play as opposed to a technical play. So you can have leverage positions in your technical plays, you can have leverage positions in your macro play, and so you're seeing the right cacophony, or the right events happening at the same time, where you're seeing all the asset classes moving in unison for a broad risk on move and a dollar play. And as you see the big clips, you can actually, if the timing and your news feed is fast enough, and your proprietary, we have proprietary ways of receiving news quickly on the floor, is then you can start, where you say you normally trade a 2 lot or a 5 lot or a 10 lot, you can get away 4, 5 times that size, because you're seeing the right dynamics happening across the asset classes in the market. And so when you're hitting the market, you shouldn't be going offside. If you time the ball, you shouldn't be going upside more than 2 ticks, but your reward is in 30 ticks if the timing is right. And then on the technical landscape, if you have a certain profile shape and it's approaching a key level that you're keeping an eye on, and then all of a sudden you see the right order flow. You might feed it with a 5 lot, and then all of a sudden there's someone that's sticking on the bid, and he keeps on reloading, and the offer is doing a certain type of flipping action because they're trying to get more on the buy side. You can start buying more and more lots because it's showing you the right characteristics. And how you define the right characteristics is the function of your experience and observing these patterns over a period of time. And therefore, you start executing instead of just your one clip. You're seeing the right order flow conditions to really start increasing your size. And when most of our traders, especially our elite and senior traders, are executing their size, they're putting their most size within a very small price zone because their timing is such that they shouldn't really be going offside on this trade. And the moment the trade is not showing you in that instance the right behavioral characteristics, you start liquidating your position as quick as possible. Because when you're starting to get your size in the market, you training your size because on the anticipation that the market should be moving immediately in that instance at that moment in time, whether it being a macro news like we had today with the Trump talking about China. You had the S&P 500. You had in Europe the DAX going hard. You get the dollar strengthening across the board, and you had even the European bond futures offering hard. And you're using all of that information to really execute a large leverage position in that moment in time when that news is breaking in the market.
That's brilliant, Alex. Right, I'm going to put 2 questions together now because the first one is: do you impose a daily loss limit on your traders? And then the second one, kind of related, is if you have an edge and you're profitable, when is it a good time to start scaling your size?
Yeah, so with regards to the first one, so one of our main things before we have any trader that trades us, who goes live, who is backed by the firm or, is maybe self-backed, is, there's always a discussion with the risk manager, but how we like to, all traders, we like them to be their own best risk managers, where they make them, but sometimes the markets are so dynamic where, there's something that just happened. There's been, a slippage in the market at a certain time. You've got a bad full or a fat finger, these things, and you're actually near your normal risk level, but all of a sudden a big opportunity comes out, and that should not stop you from getting the size, even though you're near your risk. And so remember, opportunity is dynamic. Opportunity, it doesn't happen from this time to this time. If you're down a certain amount on the day, but a great opportunity comes out, you're looking at that opportunity for that moment for what it is. The whole general kind of black and white, this is my risk and this is stop. It's only from us, from a training pool perspective, we only stop guys out if you can kind of see their patterns of tilting, and occasionally they do. I'll have to walk around, or our risk manager will have to message them, or the dreaded tap on the shoulder and saying what's going on here. And so there are some times where they do hit the so-called stop limit on a day, but it's best if they manage themselves from where their account is, and they all do have a general stop limit. They all kind of we have 2 aspects. We have a soft stop and a hard stop. So soft stop is some guys say, listen, Alex, if I get down to 5k down on the day, can you just tap me on the shoulder and just ask me if I'm okay? If I say yes, then the hard stop. If I go through to 10k, then completely stop me out. So every trade is different. Every team within our pool is different, has different approaches, but ideally we want them all to be their own risk managers and managing themselves on a daily basis.
Okay. All right, thanks, Alex. A question you might be interested to hear your answer on this. Somebody's asking if a volume imbalance on order valid, I presume he means is a volume imbalance a valid setup when it first forms on a candle, or only when the candle time frame ends? Meaning wait for an imbalance on a 5-minute chart, or if it forms during the 5 minutes ups and downs. Have you any thoughts on volume imbalances and time frames and candlesticks, that kind of stuff?
From them on their isolated own, no, but maybe within a contextual background. If you've been trading, say, gold all morning, and it's been offering down, and it's been selling off, and but it's selling off. The candlesticks, say the 5-minute candlesticks, are showing, low and lows, but they're all these doji, these doji candlesticks with these large shadows or large wicks, however you want to call it, but it's going down at a slower and slower rate, and you can feel that on the ladder. You can just feel there's someone sitting on the bid, so you can see that almost the delta, I don't know if that's another way of calling the volume imbalance, is getting progressively negative. That there's more selling, but it's not advancing down. There's obviously someone sitting on the buy side, and the moment it finds a little bit, you can get a very sharp reversal, given how the structure of the market is that time. So again, looking at it singularly at a volume imbalance or a high negative delta when the market is hardly going down, sometimes presents a trading pattern for the other side. But again, it's overlaying your candlestick formation. I mean, from us on the floor, we effectively look at your broader chart formations and your candlestick formations, as well as the profile, and then we're using of what we're seeing on the DOM to kind of find out how we're going to execute those plays. So singular candles and singular little isolated volume balances, maybe for the odd little scalp, there might be a strategy, but as a broad floor, it's not specifically what we look at.
All right, thanks, Alex. We've still got.
But remember, but just remember, there's always, whatever edge you must understand. The global financial marketplace is exactly that. You go to an Oriental bazaar, you go to a farmer's market. There's a farmer's market. There's people selling a whole variety of different things, from apples to oranges to a cheese plate to a chocolate shop. There's so many ways to make money at a farmer's market. And the same in the market. There's so many different. You've just got to find an edge that has a repeatable occurrence that you can execute with conviction. For us, executing our edges has a bit of the contextual background of the market, and so understanding the general shape of the market, and then kind of narrowing down the time frames to find that a good risk reward skew.
Okay, right. So Alex, somebody's asking, do all traders trade specific instruments, or are they quite versatile in what they trade? And it might be worth talking about new traders and the kind of more experienced guys when you answer that, if you don't mind.
Yeah, so you're asking just what people focus on perhaps in the beginning, just from training.
Yeah, just whether traders are trading lots of instruments or they're focusing on one, and if that changes throughout their career.
Yeah, so in the beginning, we really try and focus on 1, 2 absolute max. You're trying to first develop an understanding of the personality of that core market, and then you're trying to build your technical understanding of that market. So in the first really year and a half, 2 years, we want guys to focus maximum to trade other markets. Maybe for example, there's the Bank of Canada, and your core market is the German Bund or the S&P 500. There's a Bank of Canada meeting, and you've got a nice technical setup that you normally take on the Bund, and there's a binary event or a binary outcome that could come with them. Then you go, and we will allow you. If you come through and you prove that you've been disciplined trading your Bund, and you're just trying to you've done the preparation for this central bank event, then we do give the odds, but not for it to become your core market. Not after that. If you've made money, then I'm going to trade this intraday, because you won't understand its intraday personality. So the first 18 months, we really want our guys to focus 1 or 2 markets, and slowly they start branching out. And then we've got our senior guys who, even our senior guys, have 1 or 2 core markets, but they might still trade up to 12 or 14, 12 or 14 different products. But to develop, understand, our belief system is understand your one core market, understand the personality of that market, understand the order flow personality, and its technical structure. A market profile chart in the Bund has different outcomes than one in the Euro Stocks or the DAX. It looks different, it trades differently, so you've got to start understanding your core personality of your market, and therefore focus 1, 2 absolute max, but we try and say just focus on 1.
Oh, thanks, Alex. Right, so interesting question. Is there a strategy you use to refocus back on the markets after a break?
So normally it would be a questioning framework. So, we have a few on the floor. We have a few performance templates of how, it's all kind of in-house that we keep within the team, but it all kind of evolves around a dynamic questioning process. So if you've had a break, coming back to your desk, when you come back and you've had your break, in order to get your focus, the only way to get your focus is start looking across the technical landscape and seeing if you can see any setup. Instead of we don't come and then look at the ladder and start trading unless you're a specific type of trader who scalps around the algorithms and flipper. Then you're looking for just patterns on the ladder. But if that's not your style, then to find that focus is the first thing to anchor is into your technical landscape. Your charts. If there's anything interesting, you see something interesting, then you zone. Then you kind of concoct the areas where you will start participating in, and then once you've done that, then you start looking at you start then looking at the ladder of what type of order flow you want to see to start executing those patterns. So that's just a very simple: is scan the charts before you put on that trade. I've seen too many times happen to me, so many times in my career. Is I come sit down and see a little bit of lights flashing on the ladder, and I just put a trade on, and 120% of the time it's a loser. So that's way to the best way to shift your focus is really have a dynamic, objective framework of questioning opportunity.
Okay, thanks, Alex. We've got James asking, he's just using one pattern that happens. Do you recommend trying to learn more than one pattern? And if so, at what point do you introduce more?
Yeah, obviously, if you have one pattern that you've learned and that's really working, and it has a high hit rate or high reward rate when it does work. It can have a low hit rate, but when it does work, it compensates for those small losses because your risk profile is really good. You have to harvest that pattern to the nth degree. I mean, I've seen patterns in our teams for years where something exists for almost 2 years on every Friday at a certain time, and the guys extract ridiculous amounts of money from that one pattern. But like with any company, or if you have your own business, or you are Apple, and you just resting your laurels just selling the iPhone 1, eventually the iPhone 1's not going to sell as the Samsung have produced the S5, 6, 7, 8, or whatever they call them. So you always like your pharmaceutical companies, you always are having your production line of new edges, like your production line of new products, where you're doing kind of the testing and you're observing. And one of our top performing traders from last year, he was really good at trading certain flipping patterns for about 6-7 years of his career. But on the side of his eye, he started noticing certain momentum plays that he would test much smaller size. Until now, he's one of the largest momentum traders I know in the futures market, trading incredible size. And that was because he was slowly starting to work on, it's almost like the research and development department of future edges. And so he would, and so every trader should have his core edge that is harvesting the market as much. And if it's just that one pattern that's paying, you have to spend as much focus and attention on that, because that's what's paying you now. But on the periphery, always do work on potential new patterns that can be paying you, in the future. And that those patterns do just come by your brain picks up puzzles if you ask questions of the market every day, and you do pick up these patterns. So that's my suggestion.
Okay, so someone's asking about intermarket analysis, and do you have how sophisticated is your intermarket analysis, and do you have any indicators or algos that you use to help with that?
Yeah, so I mean, one case in point, if I understand your question completely, when you're looking at how markets affect other markets, I imagine is the question. Say no if it's not. But for us, no. So when there's a high correlation that starts existing in the market, you kind of see it quite immediately, especially something systemic. So the Italian elections that we've had, recently. And the Italian bonds in the future space, the 10-year bond and the 2-year bond, which are generally liquid markets, haven't been for the last couple of weeks. They on curve, And so then we start paying a lot of attention of when that move starts happening. So, from a very discretionary perspective, not using any sophisticated algos, we invest in the discretionary making of the decision-making process of a human being, and we really believe in that. So we always invest in kind of general awareness of a person and optimizing his decision-making instead of investing in, technology of these algorithmic systems. So with the B2B, we have traders who are incredibly gifted and well skilled in trading what we call crisis events, when a market is influencing other markets. So in the B2Ps, we're moving the BTSs, it would shift the Bund and the Euro in such a way that it would happen at certain times of the day that we started noticing. There's certain orders coming through at different times. So that's when we pay attention to it. We'll always pay attention to intermarket analysis that causes volume, that causes volatility. Then it's interesting to, for us. But as a floor, because, it's quite, it's about 20 guys on the floor, we pick up these things and we share, we talk about it. And so we don't use any sophisticated. It's just through our pure observation of our own eyes. We're scanning. If you look at some of the guys like, they've got probably up to 20, 25 ladders on the market, and over time, your chameleon eyes start actually being able to see that as one vision. So you can start seeing the flows, almost like a conductor. Start seeing the flow of the market between all of them and how they move, and you'll start seeing when one does really influence another, and then that's kind of your almost crude type intermarket analysis.
Okay, so I'm going to ask a question that I kind of skipped, but people told me to come back to it. It's an open-ended question, but it's kind of interesting to get your take on it. The question is, what do you look for on order flow to confirm price action at one of your levels? Now, of course, that question does presume that you've got levels in the first place for entry or exit. So you can deal with that because they keep asking it.
Yeah, I mean, that's... What you're looking for is going to be unique to every single market. There's if you've identified an area because you've been watching it on the ladder that someone has been sitting on the offer in the Bund. So let's look here. So for example, today's high. Just bring up my ladder here. So today's high is 162.55 on the Bund. 74 lots traded at the high, and 162.54 1,000 lots, and below that, a couple of thousand lots. But you've noticed someone's been sitting there and reloading the offer for 3-4 days. Every time it visits there, it reloads. So you know that there's someone been sitting there and had a large order. But every time the market offers from there, the first time it offered 50 ticks down, the next time it offered 40 ticks down, the next time it offered 20 ticks down. And then you see it go there, and then all of a sudden, the way it's auctioning you, because you've watched this zone, you've watched this level, you've watched how it's traded, and that shift, that change in the personality of the way it traded in the last 4 times it visited that region to the way it trades now is your first little clue that something has changed. So for me, a lot of the time, it's shifting the way the personality of that auction has exchanged, the way people have transacted the transaction. So, it's people... you'd see on all the social media, 5, 6, 7 months ago, everyone talking about Bitcoin. Every surfer on the planet was talking. People who had never even heard of the stock market before, whether it's been a horticulturist or some pharmacist was talking about it. So there's lots of transactions and price was going high. Now you look, there's hardly anyone speaking about it much these days. So the auctioning nature has dried. The auctioning nature of conversation has become less. And it's the same on the price side. That's what we're looking at. It's the auction market theory effect, and that's why we use the market profile. So at those levels, we're looking for a change of how it was trading before. And how you perceive that change is going to be unique to every individual through your own observation, your own, writing down. I know with our institutional training course that we do with Peter, that, we look at various drills and various, scenarios of how, of what to spot, but more importantly, how to go about developing of how you spot that for yourself. And that's really key is noticing the change in the personality of the auction compared to the preceding time that it was trading there, which will then either enhance or decrease of how much size you'll devote at that price.
All right, thanks, Alex. I'm going to throw a couple more out if you don't mind. Somebody's asking, there's various people asked about footprint charts and market profile. I guess generally speaking, what kind of things do you use on top of the ladder or as well as the ladder?
Yeah, so we have a newer generation of traders. A lot of them have use the footprint or the equivalent, these heat maps, equivalent like the Vistia and that. And they use that mainly if they haven't been watching a market. They've left the office to go get lunch, and they come back and they just want to see a history of what's been happening in these price zones, and they do a quick snapshot for the footprint or say the Vistia, and they can see maybe where there's been activity because they haven't been watching either. If you're watching one or a market that they're not trading, a core market that they're not trading, but if you're watching a market at that very moment in time and you're really looking at it tightly, and you don't need any of that because you've watched who's auctioning, where the buyers are sitting, where the sellers have been sitting, where the market is not trading much, where it has traded much. But so mainly we use those tools, those kind of order, those tools that map what's been happening on the ladder when we either haven't been away from our desk and we just need a quick snapshot and a summary of what's been going on, or a non-core market that we might trade later on when a setup comes. So from our floor, what we mainly use, we have your traditional candlestick charts. Your 60 minutes, even down to 1 minute. Over events, we even have the 1 second chart. But that's just to see, with markets moving really fast, you get these little small patterns. And then we use a lot of the mid-level to young guys use the footprint. And but what's very what prevails around the floor to understand the structure of the market and the time structure is the market profile and the volume profile. But everything then comes down to the ladder. The execution on the ladder.
All right, thanks for that, Alex. You must be feeling a bit tired now, throwing all that out here.
I do have to. I've got to do some prep for the. We've got a speaker in the next half an hour from the Bank of Canada below. So we've got quite a full floor now. And it's almost 7:30 in the evening, and they all still going to trade. So it's a long day for these guys here today.
Yeah. Before you go, can you just tell us about the live stream career trading? You've got that up on the slide there. Could you just tell us a little bit more about that?
Yeah, just to let everyone, we hold these 8-week intensive training. Go visit the website. But for all the Jigsaw clients, we are offering a 10% discount. The program starts on 2nd of July. We've got only 2. We've got now July and then 1 in October. And it's an intensive. It kind of brings you everything that what we do from proprietary trading perspective, how we approach the markets. The first 2 weeks is bringing everyone to the same level, even if you have no experience of how we look at the markets from a prop perspective. And then week 3, 4 and 5 focuses on our core, edge areas, which is market profile, market shapes, and volume shapes, various types of. And then the next week, just pure price ladder orientation. And then we look at how we trade, which I've discovered not many people, if none in the kind of non-professional arena, trade central banks and geopolitical. So we string of how we design strategies and setups. And then the final 3 weeks is a lot of drill-based. The live market's very intensive, and we reconcile during that time of what we've done on the trading floor and what the trainees have done. So they're always, practicing best practice. So go have a look. The program starts 4 spots left on Monday if anyone wants to join. And otherwise, just visit the page. You can see some feedback from our young trainees who have been on the course. So those of you who are interested from a very prop perspective.
All right. Thank you for that, Alex. And Alex, the last question is, are you going to come back and do this again?
Yes, I'll always come and do it. I'm at the moment, as we kind of expanding with traders, I have a lot of my own therapy with all the traders over here. But it's always great contributing towards the community and people just to become the best traders they can be. I know there's a reason why everyone, people who are watching this, the guys on the guys on our training floor, why we do this for this game is that we find a deep fascination trying to work out, the art of speculation, but also being independent and not being at the mercy of any corporate culture. And so this is, although it's incredibly challenging game and requires a lot of, but it's incredibly rewarding. That can give a great career, but no doubt about it. It's incredibly hard and incredibly tough journey. but it's always good to have a good framework, good methodology, and good community around you. So I'm always happy to be, and especially I know Peter's really contributes massively to the community, and which is amazing and fantastic.
Well, thanks, Alex, and I would like to thank you, everybody, for your questions. I'm sorry I couldn't answer them all. If I didn't ask a question, sorry, don't be offended. It wasn't personal. I was just trying to kind of pick the most general ones. So we'll see you in the next meeting. Thank you all for coming, and there will be a recording of this. And thank you again, Alex.
Thank you. Thanks, everyone. Have a great evening. Bye-bye.